Hello? Yes. Okay, good evening, ladies and gentlemen, and Happy New Year, everyone. Welcome to the 2026 StashAway Market Outlook event, Just the Facts. The Deputy General Manager of StashAway Hong Kong. Thank you, everyone, for coming to this event in I hope that you hear me well. Okay, right? Okay, thank you for coming in this cold evening. And I think the fruitful conversations tonight will keep you warm. So tonight we have a strong lineup from our partners in BlackRock, JP Morgan, and Hamilton Lane, and of course our CIO, Stephanie. Hello? Okay, this one is better. Okay, so this is the agenda tonight. So we'll start with an opening remarks. For anyone who does not know StashAway yet, we will tell you more about StashAway in the opening remark by our general manager. And following will be our StashAway's view of the 2026 market outlook and a panel discussion featuring the top voices from the industry. And there will be a networking event after all the sharing. So stay tuned and stay behind for a networking with fellow speakers and fellow attendees. Without further ado, may I first invite the General Manager of StashAway Hong Kong, Ronald Yim, to give us a sharing about StashAway. Ronald, please.
So good evening. My name is Ronald. I'm the General Manager of StashAway Hong Kong. Very happy to have all of you here. Maybe one question, right? How many of you have heard of StashAway or using StashAway now? Great. It's good to see so many familiar faces. And for those who have never heard of us, I'm very excited to talk more about actually who we are, what we do, and what we offer. So for people who don't know us, in one line, we're actually a digital wealth management platform to provide personalized and curated portfolio to individual clients in Asia. We want to use technologies to make investment simpler, more intelligent, and more cost-effective. And in Hong Kong, we're very fortunate to have Mr. John Tsang, former Financial Secretary of Hong Kong, to be our senior advisor. When the founder built the company back in 2016, like a decade ago, our goal is very simple. We want to help people to build long-term wealth, but not like short-term trading. For people, I know a lot of people actually coming from the financial sector actually today. Investing for many people, it could be quite complicated. Like there's too much information around. It can also be quite standardized. When you go to the bank, talk to an RM, quite likely you can get the same offering no matter who you are. And lastly, unfortunately, there's so many layers in the value chain, so the cost is actually getting higher and higher. So we want to be simpler, more intelligent, and more cost-effective. I will talk a little bit how we exactly do it in a minute. So we started in 2016. And today, we're the only digital wealth management platform that operates across 5 regions. We started in Singapore 10 years ago, then we expanded to Malaysia, Hong Kong, Dubai, and Thailand. We're backed by very reputable investors, including Sequoia, SquarePac, and Eggrose. We're also working with a lot of excellent partners, for example, like JP Morgan, BlackRock, and Hamilton Lane. And after decades, we're managing billions of dollars for more than 100,000 clients across APAC and MENA. And very fortunately, we have honored to be recognized not only by our customer, but also by the medias. For example, we awarded as top fintech by CNBC in the last 3 years. We're named by the top 20 fastest growing company by Financial Times in 2024. So we talk about our mission, right? How are we exactly doing it? Number one, simple. Simple doesn't mean we have a user-friendly app, right? User-friendly app is actually a must in today's. We actually providing very simple and curated portfolios for people at fingertips that is actually tailored to their risk profile, and we also like adapt the portfolio based on macroeconomic environment. Number two is intelligence. For individual investors across Asia, we often talk about like security selection, like should I buy Alibaba, should I buy Tencent, should I buy HSBC, right? But if we look at how institutional manage their money, they think about asset allocation, because this actually brings 90% of the return. Like, should I do in equity? Should I do fixed income? Within equity, should I go for US or China? Like within US, should I go for healthcare, like or tech? So we use data to actually bring asset allocation to individual investor, like regardless of your wealth level. Number three, trustworthy. We're managing $1 billion, trusted by more than 100,000 active clients across Asia and MENA. Number four, like cost efficient, right? With no subscription fee, no redemption fee, and our management fee is actually as low as 0.2%. It's actually much cheaper than mutual fund products that you can access from retail banks or even private banks. Number five, secure. As a wealth manager, asset managers, compliance is actually heart of our operations. So we're actually fully licensed in all the markets that we operate. And in Hong Kong, we're licensed by SFC. So many people ask us, right, how are you different from brokers, right? How are you different from IBKRs or like Futu, right? So in one line, our core offering is managed portfolios. We're not a trading platform. If you go to like a trading platform, you can actually exercise your own views. There's no advisory. You have very good market sense. You make the best trade. They provide the best executions. If you go to a bank, it's more like a supermarket model. You talk to an LM, certainly get some kind of advice. Hopefully that's actually tailored for you. But in StashAway, right, we provide curated portfolio to you based on your needs. And we provide guidance either in the app and also like by humans. We provide, and also low portfolios actually managed by ourselves and also our partners. And we actually do have very, very low fees compared to other banks and also like from some of the brokers. So what we offer, right, we're definitely not a supermarket. We provide a simple yet comprehensive portfolio to our client, meet all of their needs. We actually start from a multi-asset core portfolio, general investing. It's basically a risk-based global multi-asset portfolio that tailored to our customer financial goals and risk appetite. We have a version managed by ourselves, and we have also a version managed by our partner BlackRock. So we start from there. We can expand to cash management. We help people to invest in US Treasury very simply. We can also expand to satellite. For example, I want to have certain views, right? I want to make some bet on certain sector that I like, AI, healthcare, green tech. You can do that through your thematic portfolios, or you can say, oh, I want to build myself with our flexible portfolio. In the last 2 years, we expanded into alternative investment from private credit, private equity, private infrastructure, hedge fund, and we're also extending to like unicorn investing. So lastly, right, I'm talking about products, and we talk about like one of our like propositions, StashAway Reserve. So we started from like a more of a app-based digital products, but now we're actually more hybrid, only channels. If you're a reserve client, on one end, you can actually couple with an SFC licensed web advisor that gives you financial advice for your StashAway portfolio and also outside of StashAway. And secondly, you can access to what I mentioned, the private investment products at a much lower minimum and a much lower fee compared to private banks. So I will pass it to Pacey to our next sections.
Thanks, Ronald, for the sharing. So before I asked Stephanie to start the market outlook, I want everyone to first scan this QR code to give us some thoughts of the audience. So please vote the question among the facts. You know, today's topic is just the facts, and facts stand for fiscal, policies, AI, China, and Trump. Among all these factors, which one do you think will have the biggest impact on the market? So maybe I will just get some, Angel, can you switch to the voting? Yes. So everyone please scan the QR code, and then we'll get some voting. How many of you think it will still be an AI theme? Stephanie, do you think it will still be AI with the biggest impact?
Well, I'll go through my
Let's see if the votes are going through. It seems that there is some technical hiccups in the slide sharing, but I think that you can see the voting from the phone screen. So yeah, maybe it's stuck there, but it's fine because we got our top voice from StashAway to share her thoughts on all these factors to you. So you will get from her to see which factor will have the biggest impact on the market. Okay, if there's a technical issue, we switch back to the main slides. And then we will have Stephanie to share the market outlook with us. Chef Stephanie, please.
Thank you, Pacey, and welcome everyone to tonight's market outlook. I don't know if I'm the top voice, but I'm the only voice, I guess, that's going to speak from StashAway tonight. So I guess bear with me, and over the next 15 minutes or so, I'm going to share our thoughts on the market in the 2026 year. And I guess because we didn't manage to do the poll just now, but I still like to get some feedback from you guys. So perhaps we'll just do very, very simple, back to without technology, raise your hand. So I guess let's just do a quick poll of how many of you are bullish, bearish, or neutral on the market. If you are, let's start from bullish. How many of you are actually bullish on global equity markets for 2026? Raise your hand, I guess. All right, we've got a good number of hands. How many of you are actually quite bearish about the market in 2026? Don't be shy, it's fine. So I guess it seems like nobody's bearish. So I take the rest as neutral. So in this room, seems like we've got a pretty good overall mood for the markets going forward. So I guess tonight we're going to talk about what are some of the biggest market forces, or some of the biggest forces that's going to shape the market in 2026. But before we go into that, I just wanted to explain a little bit about the title, Just the Facts. Like, why just the facts? Some of you here are old friends, so you may remember that last year, the title of our outlook was Fat was the New Normal. And last year, what we presented was a framework to think about the market in terms of three very important developments that's not just that we think could span for multiple years. And these three things were F, which stands for fiscal dominance, which means that governments globally are spending a lot more in terms of stimulus. Second, AI, I don't need to explain. I think all of us kind of see it, feel it, use it maybe every day. T, lastly, Trump, also I don't need to explain. I mean, Ty and I were just talking how Trump has kept us very, very busy every day since the beginning of the year. So fat was the new normal, was the theme that we had in 2025. Now, fast forward to today, we've actually added one new thing, which is C. And of course, C is very close to our hearts because we're in Hong Kong, and C is actually China. So as I was coming up with the title, I thought, okay, just the facts actually fits it quite well, because I think in this world, or at least in the current environment that we're in, there is a lot of noise. And as investors, it's very important to separate what is noise and what are the main, what are the real drivers of markets. For example, Trump makes a lot of noise every day, and what is actually noise, what is actually real impact is very, very important to distinguish. So before we dive into the facts, allow me a moment to reflect on what happened in 2025. And this is a very, very simple chart, but a very powerful chart, because it shows you the 2025 return of four major asset classes that we monitor and allocate as StashAway. These four major asset classes are gold, which is very, represented in gold color, and it returned a phenomenally high 62.5%. We were actually quite bullish on gold in the past 2 years, and that was one of the, I guess, implications of Fed being the new normal. And we've actually added gold to all our StashAway managed portfolios back in April 2024. So our portfolios hugely benefited from this allocation to gold. And if you asked me last year, I was actually quite bullish on gold, but did I anticipate a 62% rally? To be honest, I did not, right? I thought, okay, 20%, 30% was a really good year, but last year was really extraordinary. And in fact, if you look at 100 years of history of gold, last year was the third best performing year in the entire history. Secondly, there's a dark blue line, and that asset class returned 23%. That was equities. It was also a very good year for equities. Now, of course, compared to gold, it is quite muted. But in terms of equities return itself, if you look at history, typically, on average, equities return about 10 to 12% per annum. So again, 23% was a very, very good year for equities. Now, the next line is 7.5%. That is fixed income bonds. That was pretty decent as well. So what actually lagged was at the bottom, a very, very flat line. That is cash. Now, cash on its own also, I guess, on an absolute basis, returned 4%, which is not bad. But if you had not made your cash work, if you had not invested, you would have actually missed out a very, very good year for most major asset classes. So all in all, last year, being an investor was amazing. It actually paid off quite well. And of course, StashAway portfolios, being globally diversified asset allocations portfolios, also benefited from the rise of most asset classes. We have a range of 12 different portfolios. For those who are not familiar with StashAway, the way we define our portfolios is by risk levels. Now, if you go to a bank or if you go to buy any fund, you would be very familiar with the risk, I guess, assessment of very conservative or neutral or very aggressive. At StashAway, we do it one level deeper. We actually define a quantitative measure for comparing risk. And this is what we call the StashAway Risk Index. It's basically a maximum drawdown number in a worst case scenario over a 12-month period. So for example, on the highest risk level, we have SRI 36, which basically means that your portfolio's maximum drawdown in any given kind of scenario over a 12-month period would only have a 1% chance of exceeding that 36% drawdown. So most people, if you are kind of medium risk, you would choose something like 20, 22. So it keeps you kind of, I guess, feeling safer. It keeps you being able to sleep at night because you know the worst case scenario is something that you already anticipate. And of course, higher risk means higher return. So last year, our highest risk portfolios returned somewhere around 23%. And on average, all our portfolios returned 17.5%. And if we compare it to the same risk equity bond benchmarks, on average, we outperform about 2.8%. So it's a very good year for us in terms of both absolute and relative performance. Now, now on to 2026. So I briefly mentioned last year was about fiscal AI Trump. This year, we added a new kid on the block, which is China. And of course, 2026 started with Trump. And I don't need to speak a lot more about these two headlines. One day is Venezuela, the next day is Powell, next day is Greenland. So we think that actually it's important to understand the motive of Trump. And what is the most important thing? The most important thing for Trump, of course, as we all know, is to win or don't lose too much in the midterms election. History is not on his side, right? History says that typically the incumbent party will lose more seats. But there are some things that Trump can do. And one of the most important things that Trump can do is to make sure the economy runs hot. And therefore, his voters, his base, feel that the economy is great and they would vote for the Republicans. And indeed, last year was a very important year because the OBBB was passed and we expect a big fiscal impulse this year. If you look at this chart, that shows you the US fiscal policies impact on GDP. And if you look at that gold bar that sticks out, that is the impact in Q1. So there is a huge impact to US economy coming into Q1 and the first half of the year as well. So we think that this will actually keep the US economy very, very strong in the first half. And that explains why US equities have performed quite well in the first 2 weeks in the year. In particular, if you look underneath, there's a lot of sector rotation going on. Right? Small caps are outperforming, the industrial sectors are outperforming. I think a lot of that is actually anticipation of the impact from the fiscal policies. And OBBB is one tool. What are the other tools in the toolbox? Deregulation is the other one. This has significant impacts on highly regulated industries, for example, banks, but also it's good for the general business environment, right? Small cap companies, less red tape, etc. Lastly, there are some other potential wildcards. I think Trump has talked about refunding the tariffs, and of course, there are other kind of initiatives that he'd like to push through. But all in all, I think one thing for sure is that Trump policies will keep the economy running quite hot, and that actually supports our collective constructive stance on equities, at least in the first half of this year. And the fiscal impulse is not just a US thing, it's actually a global phenomenon. And when we compare the government budget deficit in this chart, you can see that all the major countries, US, China, France, India, they're all running fiscal deficits and also at a level much higher than pre-COVID level. The reason why we emphasize on fiscal is to kind of contrast that versus monetary. So if you think about the last, I guess, since global financial crisis 20 years ago, governments globally have been expanding monetary base, right? When you do QE, it's a monetary policy. When you cut interest rates, that's monetary policy. However, starting from COVID, that has changed because COVID actually allowed governments to spend a lot and at the levels where it's comparable to when countries were at war because they were actually fighting a war. That war was COVID. And if you think about spending, once you start to spend, it's very hard to rate it in. So governments actually kept spending. And when we look at all the kind of major countries, all of them are spending more than pre-COVID, and a lot of them are actually spending more than in 2026 compared to 2025. And this supports global economy, again, running quite hot. However, there's a problem. The problem is when you spend, you need money to spend. So where does that money come from? Right? For governments, that income comes from tax. So governments actually need the economy to be robust, to be able to raise taxes, to be able to sustain that spending. And that actually leads us to the next topic, which is AI. I actually think that now AI is becoming too big to fail, and of course, too big for investors to ignore, because AI is the key to unlock productivity in economies and to help governments to fund their spending. If you think about AI, I think a lot of people were worried about the AI bubble, I guess kind of late last year. And I was trying to think through what is a good framework for us to kind of understand or answer that question. And the framework that I came up with is basically a flywheel. So this flywheel has 3 parts. These 3 parts reinforce each other, and if one of these 3 parts break, we have a problem. Now, what are these 3 parts? Allow me to walk you through. So on the left-hand side, you have AI breakthroughs. Now, AI breakthroughs, we're quite familiar with all the new models. For example, since 2022, ChatGPT back then was at ChatGPT 2.0. Today, we're at GPT-5, 5.2, and then this year we may get 6. So, I mean, these new models keep improving, right? Gemini actually came out last year, which beat a lot of the other LLMs. So, technology breakthrough is happening very, very in the AI ecosystem. When there is a tech breakthrough, the return on investment actually shows. And I mean, this is not something that has not happened. This is something that we can observe. For example, if you look at the Mac 7, they actually grew earnings by 30% to 40% in the last 2 years because these hyperscalers, these tech companies, they are realizing a return on investment. And return on investments actually lead to more funding into the ecosystem because, of course, money is chasing returns, right? When there's good returns from the Mac 7, we all invest in the Mac 7. And that funding leads to more AI breakthrough because you attract more talent, you have more money to buy GPUs or build data centers, and this flywheel keeps flying. And that's what we've seen in the past 3 years. And in 2025, I guess what we've seen is I guess some question marks on each one of these buckets. In early 2025, when DeepSeek came through, when actually there was some stalling in the scaling law, meaning that scaling law basically is the backbone of AI, which means that if you put in more compute, you get more intelligence. And this is basically the relationship that AI researchers believe in, which allows them to put in a lot more resources to come up with better models. In 2025, actually, we discovered, or not me, but the AI researchers actually discovered there is more than one scaling law. So the breakthrough was that they were able to use algorithms, use different techniques to accelerate this AI breakthrough. And so by middle of the year, when investors realized that there were actually more scaling laws going through, the AI companies actually started rallying again. And of course, this is Jensen Huang in his latest presentation. And he also described that today we have not one, but 3 scaling laws. And this is important to keep these scaling laws going and discover more scaling laws. And indeed, if you look at the history of these models, they keep improving, right? This is a chart that shows you how the different models actually scored on AI Intelligence Index. Even though, if you look at the scale, I mean, they seem to be scoring quite well. They're scoring right now 70, 80. But I think from all experience in using AI, there's still a lot of room to improve. Very simple example. I was actually trying to use AI to create this PowerPoint. I tried many different methods. Actually, none of them worked very well, so I ended up having to do it myself. But I mean, these are simple things that I think over the course of the next few months or coming years, I mean, those are empty boxes that the AI researchers can still work on. And I think with scaling law, they will get there. Return on investment. How do we monitor this, right? How do we know that AI companies are still getting return on investment? When we measure the usage of AI, we measure that in terms of number of tokens. And there are some very good data that tracks real-time usage of tokens. On the left-hand side, you can see an aggregation of total token usage or a kind of, I guess, representation of total usage of tokens. And you can see, maybe it's a bit small, but the beginning of the chart shows you the beginning of 2025. And throughout 1 year, token usage has actually gone up 7 times. Why is token usage important? Because people pay for these token usage, and the more token is used, the more it means that people are actually using it for a real task. I guess a lot of these tokens in 2025 went into coding. So today, if you compare if you look at software companies, a lot of them are already using AI agents to automate coding. And coding is just one vertical. There's still a lot of other verticals for these AI companies to disrupt. And I think this year, already you're seeing some signs that AI companies are tackling 2 verticals, 2 very big verticals. One is healthcare, the other one is shopping. And on the right-hand side, this is a survey that Morgan Stanley did to look at what is the percentage of AI users that have actually made a purchase based on recommendation from the AI engine. And what surprised me was actually the percentage of shoppers who says, yes, they've done this purchase is already at 40%. And I mean, to me, that is quite high because today, frankly speaking, these models are still not very good at recommending a purchase, but there is good intent. So I think this year is where we'll see a lot of advancements in AI recommended shopping. So lastly, you have ROI, you have different verticals, so where is the money coming from, right? If there's no money going into the ecosystem, everything stalls. And here is a chart that McKinsey did to estimate how much is needed to fund the global AI data center capex. And they estimated about 3 trillion. The good news is that half of this, about 1.4 trillion, is going to be funded by cash flow from the hyperscalers. So as long as like Google, Microsoft, Amazon, they're making money on the cash flows, they will fund half of this data center build out, which is very different from the internet era, because the internet era was mostly funded by debt. Now, of course, the more skeptical investor could see the glass half empty and says, what about the other half, right? And the other half will have to come from more traditional funding sources, raising debt, raising equity, private credit, et cetera, et cetera. And I think the important part about making sure we have the other half is that the Fed actually keeps the interest rate low and keeps the monetary condition quite loose. Lastly, when we look at if AI is a bubble, of course, one of the metrics to look at is valuations. And if we compare today's valuation versus the dot-com bubble era, today's trailing valuation is about 43 times. Back then, it was 67 times. So yes, of course, expensive, but perhaps, not as expensive as back then. And as long as the flywheel keeps going, high valuation alone is not a reason to call for a bubble. Now, lastly, China. So I guess we look at China from 2 angles. Number one is, the first angle is a China domestic angle. And when we look at China, the reason why we think this year, or starting from this year, we need to pay a lot of attention to China is because we think that China is quickly transforming into a technology powerhouse. We're all very familiar with EVs. I think a lot of us may drive a Zeekr or a BYD in Hong Kong. But also not just in EVs, but in a lot of other technology sectors, China is already leading. For example, in the AI ecosystem, there are a lot of optical connectors, and some of these optical connectors actually are coming from, like top-notch ones are actually coming from China. In healthcare, similar thing. If you look at some of the most advanced drug discovery companies or drug manufacturers, they are actually using Chinese companies to discover new drugs and do trials. So I think these are areas that China is, I guess, starting to dominate. And I think if anything that we've learned from 2025 is that China could become a disruptive force in terms of AI, in terms of other technology areas. I think more interestingly, from a macro perspective, China can actually be a hedge, somewhat of a hedge to US tech stocks or US AI story. And when I talk about funding, I mentioned that the precondition for that funding is that the Fed actually keeps monetary policy quite loose, right? Keeps interest rate low. And the key reason why the Fed can keep rates low is because there's no inflation problem. And one of the key ingredients for that is that oil prices actually stay low. Why is oil prices staying so low even though the global economy is doing well? It's because China is still slowly recovering. China is not yet wakened. So here there are 2 scenarios for the Chinese economy, and we monitor it very, very closely. The first scenario is a slow stabilization, so a recovery, but a slow recovery, right? Because as we all know, China is still recovering from a property slump. And when we observe like all the real-time data, it's still fairly slow. And it is indeed our base case. So China still continues to export deflation. A lot of us spend money, go to Shenzhen. Things are very, very cheap there. Renminbi is also quite low. And therefore, if China is exporting deflation, it supports a loose policy in US without causing inflation. So that's all good, right? Everybody's happy. What about the other scenario? Scenario B is that for whatever reason, maybe it's because of the technology advancement in China, maybe because it's a policy change, there is accelerated recovery in China. Of course, this is great for Chinese equities, right? This is great for Chinese assets. But it actually poses a problem for US assets, and in particular, tech assets, which are high valuation. Why? Because, I mean, that could start to, increase the demand for commodities, increase the demand for oil, and therefore it could lead to accelerated inflation or re-inflation again in the US. And then the Fed has a problem because they cannot cut interest rates anymore, or they even have to increase interest rates. And as we have all learned in 2022, it was not a great scenario for tech stocks. So I think China here actually in a portfolio plays two parts. Number one is you can get some upside in terms of the tech advancements or a separate stack for China, but also I guess somewhat counterintuitively, it serves as a hedge for your US exposures. So lastly, I guess in StashAway, what we do is that we use a systematic way to allocate our portfolios, and it's based on an economic regime model, which detects where we are in a cycle and allocates accordingly. We don't change our allocation according to what Stephanie thinks. We change only our allocations according to what the model tells us. So everything I say here are what we think will happen, but of course, if the model tells us that we're observing a change, we will adjust our allocations. And as of today, we are still in an inflationary growth environment, which means that growth is robust, but the inflationary pressure still persists. And lastly, what does facts mean for investing in 2026? So what do we think about different asset classes? Firstly, equities, we're with most of you, we still remain constructive. We favor stocks, particularly over bonds, and we still continue to prefer gold, so we still have our gold allocations in all our portfolios. And in particular, because we expect volatility to be quite heightened, gold also acts very, very well as a defensive asset allocation in a portfolio. Lastly, diversification is also important, which is why we introduced China into the picture, and we encourage everyone to think about how you put together different non-correlated assets in a portfolio so that you can sleep at night and you can enjoy the long-term compounding impact or effect of asset classes over the long term. Lastly, key takeaways. Very quickly, a few points. Number one is that 2025, our general investing portfolios returned 17.5% on average, and we outperformed benchmarks by, on average, 280 basis points. In 2026, we think the facts will actually drive macro and market environments, and these stand for fiscal dominance, AI advancement, China's recovery, and Trump's agenda. Positioning start of the year, we prefer stocks over bonds, stay invested in gold, and also consider some portfolio diversifiers, for example, China. Lastly, of course, as we always preach, stay invested, stay diversified. With that, I am done, so I guess I'll pass it back to Pacey.
Thank you. Thank you, Stephanie. So now the hiccup is resolved, and I got the data of your voting. So actually, over half of you think that Trump is the biggest the factor with the biggest impact on the market with AI as follows. And now I will invite the panelists, the panel speakers, to see if they agree with these factors. Yes. So Stephanie, can you please join us on the panel first on the side? On the side? Yeah. Yes. Next slide. Yeah. So first, may I invite Nick, Vice President of Investment Strategy of BlackRock, and Tai Hui, Chief Market Strategy Asia Pacific of JP Morgan, as well as Shannon, Managing Director, Head of Greater China Client Solutions of Hamilton Lane, to join us on the stage.
maybe I'll borrow your mic. Well, so first of all, thank you so much for, I guess, being with us again. We have old friends, Shannon and Ty. We also have new friend, Nick. And I get to do the fun part of interviewing all of you and asking you about your 2026 views. So I guess, because we talk about the facts, so allow me to ask the questions along the lines of these few things. So I guess the first question to Ty and Nick, we talked about fiscal dominance, right? We talk about global governments are all spending a lot to support the economies. How sustainable do you guys think these kind of fiscal policies are? And what do you think are the implications in terms of classes or your views on markets in general?
Yeah, I'm happy to start here. Thank you all very much for having me here. Does this one work?
I guess we only have one that works.
Pass it that way. Thank you very much. Thank you all for having me here. This is a really interesting question. I think actually what you went and touched upon at the start defines it actually quite well, which is that there's sort of this circular economy going on. One of the things we went and saw last year in 2025 was that US GDP growth was very much driven by fixed investment. This is AI CapEx that's showing up in the economy. Now that can only be sustained if you effectively have easy financial conditions where borrowing is relatively cheap. In order to have cheap borrowing, you then go and have strong asset returns. You need the productivity growth, the economic growth to follow. And this is very circular. If you go and get an environment in which borrowing costs go and rise, especially above the rate of productivity growth or that economic growth, then you'll find yourself in an environment where this circular sort of economy comes crashing down. One of the biggest risks that we're looking for in 2026 is what is that level of higher borrowing costs that would go and mean a bit of a drawback in terms of that economic growth and that economic potential. One of the things we saw in the back half of last year, for instance, is that we went and saw a lot of these AI CapEx, these AI companies start to go and fund their CapEx via debt-driven spending. And when they went and tapped into capital markets, we went and saw spreads, we went and saw borrowing costs widen, especially for other companies. This puts a halt to some of the economic activity going forward. So this delicate balance that's taking place in the economy has to go and keep going. This is why Trump, the administration, Treasury Secretary Scott Bessent is so focused on keeping 10-year borrowing costs lower, on appointing a Fed chair in order to go and cut rates and keep borrowing costs down. So it's a fine, delicate balance. What does that actually mean, though, when it comes to investment implications? It's primarily two things. One of the things we often say is don't fight the Fed. I would go and double down on that and say don't fight the Fed and don't fight the Trump administration and what they're trying to do. I do believe them when I say that they're going to try to go and keep borrowing costs down, when they go and say it explicitly that they're targeting 10-year yields and keeping those relatively low. The second aspect of this, however, is that when we go and look towards especially fixed income, it means that long duration bonds aren't necessarily going to serve as the ballast in a portfolio that we normally expect them to. It means we need to look for differentiated sources of income. And there's lots of great income out there. The best predictor of return in fixed income is your starting yields. So when we go and look at the overall fixed income environment, there's plenty of opportunities, there's plenty of high income assets that we can own. It just means that we need to be a bit more careful about our portfolio construction, our portfolio design, because long duration assets may not be the ballast that we're necessarily looking for.
Yeah, I think actually fiscal discipline was one of our key themes for this year as well. If you look at a bunch of developed economies, you've got countries like Japan, which we've seen a gigantic jump in bond yields in the last couple of days.
JGB passed like 4% today.
Yeah, exactly. And then you've got the UK, you've got France, which have been through quite a bit of a fiscal challenge in the past couple of years. What you find is that these economies or these governments have a similar situation where the parliament, or rather, the government does not have complete control of the parliament. If you look at France, it's a very fragmented parliament. If you look at the UK, Labour Party, despite a landslide a couple of years ago, popularity is very low. Japan, likewise, LDP lost the election last year. So I think what you go through right now is for the governments who are struggling to regain voter support, they have to give voters what they want, which is lower taxes and more spending. And they are more at risk of being punished by the bond market. At the same time, you do have good stories. If you look back to actually your chart at the beginning, the tape was really good. You saw countries like Italy, Spain, Portugal, Greece, remember PIGS back in the 2012s. They actually got their work done in consolidating their fiscal position. They got upgraded. They're now actually, some of these countries have higher rates, sovereign ratings than France. So I think there's still opportunities in government bonds. I do agree with you, Nick, that I'll prefer short to medium duration, because that's where the Fed can really control US Treasury yields. But frankly, I'm not entirely sure whether Trump and the Fed have complete control of the 10-year and beyond. So I would rather take a bit of a carry hit and stay, for example, 2 to 5 years. But if the Fed does cut rates later this year, bond yields comes down, I get capital gain. I don't think you're going to get the same juice out of the longer end of the yield curve. At the same time, I do agree that economic growth in the US, at least for the first half, looks pretty solid, which means if you look at things like high-yield corporate debt, you're still getting 7 to 8% starting yields. Spreads are super tight. You're not going to get much out of it. But I'm happy with getting 7 to 8% in terms of coupons with relatively manageable default risks, at least for 2026.
Yeah, that's great. And I think if we think about debt sustainability, I guess that leads to our point that AI cannot fail, right? Because if AI fails, then I think there's a lot of issues that will surface, which leads me to my next kind of bucket of questions around AI. I think we all kind of watch AI very, very closely, and there's a lot of new developments. It's very hard to predict where things may go. So I guess we all sort of operate in slightly different time frames. For example, China operate in a very, very long time frame because most of your investments are actually private and illiquid. So when you think about AI, like how should we incorporate the uncertainty of AI into your investment strategy? Maybe we'll start with Shannon.
Thank you. I think AI is a hot topic for sure. Actually, from last year, I already received a lot of questions from my client. The first thing is to ask about whether there's a AI bubble. Okay, I think let's go back to this important question. I give you two scenarios or two perspectives. One is from my professor from my EMBA class from Northwestern University. The professor that just have the class in Hong Kong. I particularly shortened my holiday trip just because I want to attend this class. I asked the same question, professor, because he owns 5 AI companies, so he is very well positioned to answer this. He mentioned to me, he answered my question, yes, he believes that is an AI bubble. But one point is very interesting. He thinking the AI bubble, yes, that is, but in a few years later, once the bubble gone by kill some of the small company, they will come back. So I think that is making very good sense. If you mention no AI bubble, that I think something wrong, but the point is they will come back again, meaning they will pick up again. Okay, this is my professor version. I give you Hamiltonian version. I just spoke to my colleagues from US. We also believe that is some bubble. But one point is we focus, like Stephanie, you mentioned, or we do all private. So we invest in VC and growth. So how we're going to integrate in our portfolio is we not just look at, I think that's some very like a term, LLM, right? So larger learning model. A lot of AI companies, they build a model and then like the data facility. But what we really like is we like those companies that integrate this model to generate the return. So back to your question is, we think there's an AI bubble, but that's a way to find some portfolio company. They can utilize the AI model to generate a better return. I think I really like what you share about that's an AI, that's a different stage. So we are actually, when we integrate into a portfolio company, we are getting that. We not just look at everyone knows those company build that LLM, right? So we try to get really, the company can utilize that to generate the return. Yeah, so this is a way that we try to live with the AI bubble.
I think it's a slightly different view on here because if you look at Max 7 performance since Q4 last year in the first few weeks of 2026, markets started to differentiate. You've got, I can't name names, but you've got company A who are quite transparent about their pipelines, their business revenue, where it's going to come from, and who are their clients, and their stock price tended to do quite well. You've got company B who are quite vague and fuzzy about what they're doing and who their clientele is going to be. They get punished. So in that sense, I think the market's already differentiating or starting to pick winners and losers. To me, when they're that rational, it kind of is the definition of we're still not in a bubble. Yes, some companies will fail. I agree with you. And if you're trading at 30 times PE, sure, that's expensive. But if a company's trading at 30 times PE, but then they're going to progress to become the winner in 3 or 5 years' time, then that's okay to me. At the same time, we're looking for opportunities that are not only focusing on picking the winners and losers, we're trying to find infrastructure plays that we think will benefit regardless. For example, if you look at the power generation capacity in the US, it's super stretched. They have not added generation capacity for 15, 20 years now. So it's very difficult to kickstart that electricity growth or power generation growth right away. If you own power stations, congratulations, you are going to have a lot of pricing power. The funny thing is they're actually starting to use jet engines to engineer electricity. That to me is how desperate they are. Now, the other thing is actually coming back to Asia. If you think about the components that go into data centers, the semiconductors, the RAM, the memory chips, who's going to make these guys? Taiwan and South Korea. They are the most dominant players in this area. Now, regardless of what's happening in the US, China will need some of those. Southeast Asia could need some of those. Europeans could need some of those. So in that sense, if you genuinely believe that AI is going to be a success in the longer run, you don't have to choose company A or B or the hyperscalers. You can actually just go and invest in APAC companies that are making the components that feeds into the computing power.
I'll just add 2 quick points. First, when people are asking the question of are we in a bubble, that actually makes me feel more confident. Those are the questions we need to be asking, that the market needs to be debating. And when we go and see that take place, it just makes me feel more comfortable about the actual investment within that theme itself. So that's the first thing. The second thing, and this goes back to Shannon, your point on what's actually taking place here. If we go and look back towards the 2001 dot-com bubble, for instance, we went and saw a lot of borrowing and we're going to build out the infrastructure of the internet. Think the fiber optic cables that were laid down. Those companies, they struggled thereafter. They went and built this infrastructure, but what it led to, however, was the backbone of the internet. It enabled the next generation of companies. It enabled cloud computing. It enabled connectivity via applications, the rise of social media. This all was built on the backbone of the internet, and this was heavy borrowing up front, and then the infrastructure that was laid down in order to go and build it out. So when we go and think towards, hey, who are the beneficiaries right now? Who are the beneficiaries in a couple years? What does this actually look like? It usually goes and follows a simple cycle of this infrastructure being built out, maybe to a certain extent an overcapacity to some degree, cheaper costs, and companies and individuals being able to go and use AI at productive means, and you're going to get a new spawn of companies coming from it. So who and where do we want to invest right now? Our primary place, similar to what Ty is saying, is the actual where the money is being spent. This is towards the physical hardware, towards the companies that are actually producing the energy or the memory chips or the various other components of these large data centers. We think that down the road, there's definitely going to be on the software side companies that will go and be a beneficiary of AI in the true sense of the word. However, right now, we don't really have a clear view into who those companies are. It'll be one of those things where 10 years from now, we'll look back and it'll all be obvious. But I think 2001 does go and serve as a good example, where as we look towards infrastructure being laid down and what it means to actually be in a bubble, of course the companies today that are going to be benefiting are not going to be the companies 5 years from now. This is a cycle, it's a build out, it's a revolution, technological revolution that's taking place, and we think it will continue as a result.
Yeah, I think there's definitely a lot of opportunities. I think it's also important to, I guess, recognize that even though there's a lot of bottlenecks, I mean, there is technology advancements which may debottleneck a lot of these problems. I think the latest idea is to actually put data centers in space, because in space you can get unlimited solar power. You don't need to cool the data center, and you can use a lot less transistors. So who knows, right? I think human advancement is something that we can always look forward to. So next topic is, I'm going to move to Trump and China. I put these two together because they are, I don't know, they're like husband and wives like fighting. And it's like, oh, who's winning, who's not winning? But we don't have a lot of time, so I have 3 questions, and I'm going to do it differently. I'm going to ask that question and see, I mean, who would like to take that question. First question about China. So I think actually quietly Chinese equities have performed very, very well, right? If you look at the Asia is having a good run. What do you think about this year? Is China equities going to continue to have that phenomenal return? Maybe Ty? Yeah.
Yep, I think so. I think a couple of things. First of all, don't invest in Chinese equities because you think the economy is going to do fantastically well. I agree with your assessment that it's going to be a slow recovery, 4.5%, 5%. They're still stuck with the housing market. They're still stuck with the labor market. So from that perspective, you have to look for themes in the Chinese market. I think the government is clearly very willing to work with the private sector to develop the AI capabilities, because ultimately the government cannot do it by themselves. So that gives us a lot of opportunity for the first time since 2020 when the tech crackdown took place. If you look back to the past couple of years, the Chinese market behaves in a way that a certain piece of news comes out, whether it's government policy or the DeepSeek moment or a new product launch, the markets will react very quickly in a very short space of time. And then it'll go flat for a while, a new piece of news comes up, they jump. So stay invested in Chinese stocks, to me, is the only way you can benefit. You will not be quick enough to catch that spike. But at the same time, AI to me is going to be another key themes for China. In the US, monetization, subscription is the way forward. In China, it's all open source, which means no matter how great your model is going to be, you're not going to be able to make much money out of it. You have to integrate it with a particular service, whether it's e-commerce or financials or healthcare, et cetera, et cetera. So that gives you a lot of a lot of direction in terms of the larger players who can integrate these models quicker. They've already have a certain platform. They are in a better position than some of the potential niche players. Advanced manufacturing, that's where the Asia market comes into play. Hardware, GPU makers, memory chip makers, the import substitution play to me is also going to be quite important. But finally, on the issue of investor base, I think international investors have just started to come back to Hong Kong. They're not back into the Asia market. So, if you're going back to the Chinese market right now, you are not going to be the last. You're not even going to be in the middle of the pack. You're probably still some of the early movers. So that gives me quite a bit of confidence on the China market.
Yes, agree. And I guess next question related to that, Trump and China and I guess the world, right? There's a lot of, I guess, uncertainty as to where the world is heading in terms of geopolitical kind of conflicts or non-conflicts. So maybe this question is for Shannon. How do you incorporate that into portfolio planning, right? Particularly in more illiquid portfolios.
Thank you. Actually, I'm still thinking of how to address this question in a better way. Okay, my short answer is so difficult. Okay, so I think let's put it this way. So that's a super difficult to predict, right? Because I think everyone agree, Trump change every day. So that's why it brings a lot of uncertainty to the market. And also that means because I looked after the client portfolio, so it's very difficult to construct a portfolio. You basically need to bet what is next week or next month, what goes on with the US market. But one thing I think is very important is, I think very old terms, diversification and portfolio construction. So I know sometimes I mentioned to the client that you need to very diversify and also have a good portfolio construction. Sometimes people thinking, okay, this is nothing new. Yes, nothing new. But I share the real case with my client. That's myself. I can show you now. So I actually invest so I come from Hamilton, very, very hard sell. I invest in 7 Hamilton funds. But I can share with you, approaching 9 years with Hamilton. In the past 5 years, I only invest in closed-end fund. That is our direct equities, co-investment fund, and also PE secondary fund, global one. But in the past 2 years, I forgot those closed-end fund. Because it takes 10 years for me to get the last bunch of the money. That's a huge uncertainty. But having said that, I have a bunch of the institutional clients still really like long-term, 10 years duration fund, no problem. But I got a bunch of the private wealth client, and myself as an individual, I like liquidity. I like the option. It doesn't mean I need to redeem in next month or next year, but I need the liquidity. That's why I invest in 5 Hamilton evergreen fund. And interestingly is, I'm using myself to construct my portfolio. I invest into PE, I invest into private credit, I invest in infrastructure. Within PE, buyout, VC, and growth. So back to the question, I don't care. Next month, next week, how's the Trump policy? Because my portfolio have a good balance of equity and also some yield generation strategy. So of course, I think, Stephanie, you asked at the beginning, who thinking equity is still really bullish or bearish? I still raise my hand, equity is more bullish. That's why my portfolio, majority 60 to 70 is still equity. So I think this is when we're thinking about how to integrate your portfolio, I'm not the God can predict, so 1 year later, how's the market? But you ask yourself, right? So what is how you thinking your portfolio? And I think this question also meaning what is the risk, right? So I tell you 2 risks. One is uncertainty about the liquidity, which I think you can adopt some evergreen strategy to have a partially cover. Another risk is actually not being in the market to consistent investment. I tell you why does it matter. If you thinking too much risk, you do not invest, you actually miss the vintage. I think Ty or Nick, you agree, right? And also back to, we come through a lot of economic cycle. Maybe you do not feel that, but some of our institutional clients really, after any financial crisis, they feel they miss the vintage because they're thinking too much risk, so they miss that vintage, but it ends up is a very good vintage. So this is not being in the market to consistent investment is also the risk. So I think back to your question, you need to think about why you need to have a very holistic portfolio. That's why I think your team help the client can achieve that because you get the option, different scenario. I still have one question to ask the people, which is I can pass the Ty and Nick to. This is my real case. I have some cash here. If I invest in so many funds, but I have 2 options. Everyone agree is a property market in Hong Kong picking up? I think some, right? I have 2 options. I want to use the cash to buy a new apartment to my mom, but I also have the option continue to top up to our funds. Our fund in general are around 10% return. I have 1 year to make the decision. Anyone think I should buy the property? Anyone? Give me the advice. Okay. Option 2, should I put the cash to buy into the fund to achieve any return around 10 to 12%? Maybe after 1 year later, I can buy a better apartment to my home, my mom. See?
Mainly residential, right?
Yes, yes.
If that's the case, then you might as well just hold on to whatever you do for 1 more year, wait till it stabilizes,
That's great. Yeah. You know what is, I'm also thinking the cost of investment, right? If not put into the investment, but I put in I'm thinking the property market goes up, I don't know how quick they goes up. But I'm for sure, if I put in the top of my funds, I can achieve around 10 to 12%. So I want to give the message, what is the cost not in the market for investment? Okay.
I guess, yeah, thanks for sharing the fund because they are all available on StashAway. So by selling the Hamilton Lane funds, we're also selling StashAway. We have a question.
Yes, so clearly if one's coming to Hamilton Lane, it's because they want private equity and venture capital exposure. No one's going to go to you for the public equity exposure. What have you found to be the way to invest to maximize the return over a longer period of time? So if you're running the time series in order to try to catch the right vintages, is it, you guys do annual vintages, right? You guys do annual vintages?
Yes.
Okay, so is it, in order to catch the right vintages, do you invest every 24 months, 18 months, 36 months? Have you run that analysis? What does that look like? What are those returns over a long enough time period? And do you do something which is a mix of secondaries, co-investment, and primary? Because I think you talked about doing both secondary and primary. But what do you find as to be the optimal mix as well? So optimal mix in terms of those 3 categories and what time series you're using. And the mics don't work.
Okay. Okay. In the interest time, a very quick question. Because we have evergreen fund, also in the StashAway platform, we actually is not just invest on any basis. We invest every month because it's a monthly subscription. So I think stay behind. I can address those in more detail about primary and secondary. But I think I want to pass the time to the rest of the speaker to tell more detail.
Maybe I'll ask the last question. So I guess because we're talking about Trump, right? And one of the gifts that Trump has gave us this year was that I'm going to do everything that I can to fire Powell and even put him into jail. And that puts into the question of Fed independence and a lot of longer-term implications. So how do you guys think about that, and how should we incorporate that into our portfolio design?
Yeah, definitely. As the token American, I'll try my best to go and look into Trump's mind and tell you what's going on. Obviously, when it comes to Fed independence, this is incredibly important. And we've seen the market reaction be actually relatively muted. I think one of the reasons for that altogether is because of the outrage that we went and saw from global central bankers and from Republicans, if we're being honest. Questioning Fed independence is not good altogether. If you go and look towards even probably what I would say is the most trusted individual from a market's perspective, Treasury Secretary Scott Bessent, even he was relatively upset with the Trump and the rest of the administration for even going about and doing this in the first place, considering the fact that Powell's term is almost up. With that being said, no matter what, the next Fed president is going to have to contend with this. And that's actually, it's a pretty big deal. Maybe you go and have an easing bias implicitly there, but you're also going to get this pressure from Trump explicitly, from the Trump administration more broadly, on trying to go and juice up the market in some way, either by easing policy, maybe by accounting for treasury purchases, maybe by introducing some sort of stimulus here or there into the market. So you're going to have that bias. Again, this is one of those things where I go and say, don't fight the Fed on this. And even if it's taking in some way in implicit direction from the Trump administration, I wouldn't go and fight too hard against it. It means that maybe the economy runs a bit hot. Maybe there's a bit more of an inflationary bias within the U.S. economy more broadly. But what we do know it means is that we do think that the Fed independence does go and stay relatively intact. We saw the outcome from the global central bankers being able to push back. We saw the outrage from Republicans in the House and Senate push back. We think these are important indicators that overall Fed independence remains relatively intact. We just do know that whoever is going to be coming up next is going to have this cutting bias ingrained in how they're going about their business. And I think just one last thing I'll go and add on this really quickly is that that bias towards cutting itself may not necessarily be a bad thing. We're seeing the labor market really start to go and fall off in the US. Although we do see household balance sheets in a relatively strong place altogether, a no hiring, no firing environment, that's a very tenuous balance to go and have over the long term. You can't have that. That's not conducive to economic growth altogether. So if we continue to go and see inflation relatively contained, and the latest inflation reports do go and point towards that, services inflation continues to run down, the tariff pass-through effect seems rather limited. If inflation remains contained, you will see the Federal Reserve start to go and shift what they're looking at towards the labor market, and there you may continue to go and see probably a couple more cuts than I think markets are actually pricing in right now, or at least maybe front-loading some of those cuts rather than pushing them all the way out till 2027.
Can I just add one really quick point? Actually, I was talking about this before we started, and one thing that actually can limit Trump is the market. If you think back to April last year, he announced the tariffs, the market freaked out, he actually pulled back. So if he was doing anything that could bring bond yields to 5%, or the stock market down 10, 15%, that might actually just bring him back to some extent. So in a way, maybe the market's not reacting right now because they see it, okay, we have the power to control or limit the president, and therefore I don't need to sell down because I don't want to buy back. That might be one interpretation right now, but I think that in itself can help to limit some of these policies that can potentially be quite damaging to the US economy.
Trump thinks equity market is on his scorecard. I guess we're fine. So one very, very quick concluding, sort of a quick fire one. So we talked a lot about facts, right? This is sort of our framework. What are some of the other factors that you guys think are important that maybe keeps you up at night, or that may kind of impact your asset allocation recommendations? Maybe we'll start from Nick again.
To be honest, I'm actually thinking of adopting the FACT framework. I think it accompanies everything. The one thing I'll just go and say is one of the implications from all this, which is dispersion. We think within equities, whether it's in the US or Asia Pacific, there's going to be high dispersion. Whether we're looking at credit markets, there's going to be high dispersion. Takes a well-diversified portfolio in order to go and access, I think, most of the opportunities. It takes, in some ways, active management in order to go and access a lot of the opportunity set that we think will come out. This is the implication of, I think, FACT altogether, is that when you go and get a lot of these idiosyncratic and then structural tailwinds going forth, there's just going to be higher dispersion going forward, especially at higher valuations. It's going to be tougher to go and find a bit of alpha, a bit of outperformance. So the key thing that I would just say is just this dispersion aspect is going to be a big thing, and is going to guide a lot of portfolios into the new year.
Yeah, I think your scenarios actually covered a lot of ground. So I don't think there's anything that was particularly missing. What I'm worried about is things that we cannot foresee. And one thing that really hits the market, and we saw that in 2022, was a spike in inflation because of war, because of geopolitical events, because of, a ship got stuck in the Suez Canal. These things to me will policymakers find very difficult to address, because if you have recessions, cut rates, boost spending, that's okay. I think central bankers and governments find it very difficult to deal with inflation. Governments find it very difficult to deal with inflation. I don't think that's a major risk per se, but I just think as an investor, that's a much more difficult scenario to handle than a recession.
I echo Ty. Actually, I spoke to my colleagues at US team. Exactly. Everyone know Trump would like to change the chairperson of the Fed and then lower the interest rate. Everyone know that, right? It's not new. But something like Ty mentioned, inflation is something that he cannot have a full control. So what our view is thinking is, yes, the interest rate will going down, but not as everyone thinking too quick, because there's a risk of inflation. So I think this, I agree, this is one of the ways that people difficult to predict, because Trump is just thinking very simple. They lower the interest rate, everything go back to great normal, but the economy is not as simple as he think. Yeah, I think this is something we need to mindful that also impact your decision on your portfolio.
And that, of course, is something that we monitor. And I think to maybe add one more to that, and I think last year we started to see some pilots use case of AI at the enterprise. I think this year we're going to see a lot more. And one thing is the labor markets, or its impact on the labor market, which is quite uncertain right now. So I think that is perhaps another area of risk that we're closely monitoring. So with that, I guess that's all for the panel session. We have a Q&A.
Yes, due to the time limit, we have selected one question online.
Only one lucky.
Only one. For the rest of you, if you have a question, you can network with our fellow speakers in the networking session. So this question, so name one investment theme that you will focus on in 2026 and one that you will avoid in 2026. In one sentence, everyone.
Wow, okay. I guess we've been too long-winded, which is why we can only use one sentence. Anyone wants to start?
Oh, sorry.
Okay.
AI applications, but not just the services, manufacturing, robotics, autonomous driving. That's what I think is going to be interesting. What I would avoid, interesting enough, defense. I know everyone's talking about more wars and more spending, but it's come a long way already. I genuinely question how much can developed market governments spend on defense. So that's something to watch out for.
I'm big fans of second strategies. Particularly, I like infrastructure. So I'm thinking that integrate a lot of like AI data center, which as we mentioned already. So what I'm going to avoid is very interesting. I'm thinking of a Bitcoin for long term, but I'm not still in the Bitcoin space. I almost buy Bitcoin last year, but I paused a little bit. I spoke to my friends who were in Bitcoin or tokenization world. I decided to avoid this year, but maybe in 2027, you ask me again, I'll let you know.
All right, maybe you guys will have a private Bitcoin fund somewhere. I guess for me, I think this year what is interesting is anything that's outside of Max 7. I think with the broadening of the economy and with the broadening of use of AI, I think that benefit is going to spread to more companies. What I would avoid still is some of the software companies, because I do think that AI is a big disruptive force on these software companies. It's very, very hard to go back to the old business model. So that was more than one line, sorry.
No worries. I believe that everyone's looking forward to this fruitful question and answers of yours as well. Thank you for all the speakers for your great sharing. Thank you. Thank you.
Thank you very much.
Yeah. Let's do a group photo first for the speakers. Okay, great. Thank you, everyone. Thank you. And before everyone starts the section, I just want to mention that just now you hear insights from the speaker. And now I think it's time for implementation. So for StashAway, we have a full suite of smart products to help you implement your views, from cash management to our core portfolio general investing to the private markets and other alternative investments. So they all align with our value of simple, intelligent, and cost-effective. And I also would like to mention that some of you today are new to StashAway, so we do have a promotion for new investors. So simply open an account, input the promo code, and start investing. You will enjoy the benefit. So, and also, if you would like to speak with wealth advisors, you can also scan the QR code to arrange a meeting with our wealth advisors. So thank you everyone for joining today, and let the networking session start. Thank you.